Thank you for joining Jennifer Schaus and Associates in our 2019 Webinar Wednesday series, where we are coming to you live from downtown Washington, D.C. Webinars are every Wednesday, and you can find the upcoming schedule on our website. Past webinars and recordings are also on our website and on our YouTube channel, along with over 160 other recordings on federal contracting topics. All are complimentary. If you have questions for our speaker today, you can email her directly with the contact information on the last slide. All right, just a little bit about us. We are a Washington, D.C.-based firm and provide services for federal contractors. This ranges from market analysis support to proposal writing and also post-award compliance. More information is on our website, so please visit us. And these are a couple of upcoming events that you can find more information on your screen or also on our website. We now offer advertising, so you can contact me with the email you see on your screen for more information. And our webinar today is sponsored by AccuTrack, and here's a short message from them.
AccuTrack Consulting and Accounting Services is an 8A WOSB CPA firm committed to supporting entities that sustain growth in government contracting. Our outstanding DCAA accounting solutions reduce audit risk, improve cash flows, and give you peace of mind. Contact us today to learn how we can enhance your DCAA accounting efforts.
Okay, so let's go ahead and get started. Our speaker today is Heather Newland from Newport LLC, and we are going to be covering growth via acquisition. Thank you for joining us today, Heather, and I'm going to go ahead and hand it over to you.
All right, thank you for inviting me to speak. I am thrilled to be able to share this content with your audience and look forward to the questions that will come afterwards. As I stated in previous webinars, I've spent about 25 years of my career in government contracting and technology, mostly at the large systems integrator. As a general manager, I oversaw portfolios of up to $175 million in annual sales and led teams across the intelligence, defense, and FedCiv markets. Currently, I serve as the government contracting practice chair for Newport, where I focus on working with small and middle market business owners to accelerate growth, fix operational issues, and prepare for sale. Frequently, this also means preparing for small business graduation, growing via acquisition, and establishing an advisory board. Today, we're going to talk about whether you should consider growing through acquisition as either a small or middle market company in government contracting. Next slide, please. The purpose of this webinar is to provide an understanding of the benefits and risks to growing a business through acquisition. As a business starts the transition from small to middle market and working to compete in the middle market, considering an acquisition to accelerate growth is a common strategy, especially as you're working to get to the $100 million or $250 million mark. A lower middle tier organization defined as greater than 10 million but less than 50 million in annual revenue may consider the purchase of a smaller business. Alternatively, in small transactions, a buyer may acquire a company of the same size. A growth via acquisition strategy brings rewards and risks. This webinar will provide the pros and cons of such a strategy to help business owners make an informed decision on whether the rewards outweigh the risk. While the information presented is relevant to all lower middle market M&A activity, the perspective presented is targeted to the government contracting industry. Next slide, please. A quick glance at the table of the benefits and risks provided may lead to the conclusion that the benefits are greater than the risks, but the benefits are not guaranteed and the risk can cause significant harm to the business's viability. The benefits of an acquisition with the most significance include instant growth, entry into new customers, including gaining relevant past performance, expanded technical offerings such as new products or services, back office efficiencies with the capacity to bid larger contracts, and M&A experience. At the same time, the risk of an acquisition can be numerous. We will focus on increased debt or lower working capital, operational distractions associated with conducting the deal, integration challenges once the deal is complete, inaccurate assumptions and projections, especially with respect to synergies and long-term value, and M&A experience. Now note, M&A experience appears both as a benefit and a risk. This will be explained later in the discussion. Let's explore each risk and benefit in more depth. Next slide, please. An acquisition enables instant growth. The combined larger company should theoretically have greater resources. For example, past performance, capabilities, business development staff. If the acquisition is strategic, the new company should be better positioned to compete in a full and open basis on government contracts. One of the most promising benefits of a larger company is helping a small business move from subcontractor role into prime contracts due to the additional capacity it has to support customers. In addition, companies with increased revenue tend to sell for higher EBITDA multipliers. However, for small acquisitions, the change may not be noticeable. While a merger of two same-sized companies can be impactful, showing continuous growth and strong year-over-year growth is important for calculating valuations and securing for future capital. Note, in business valuations, inorganic growth via acquisition is measured differently than organic growth. Therefore, acquisitions should be used for strategic purposes rather than trying to achieve growth targets. The strategic reasons are discussed further below, but include gaining past performance into an adjacent market, obtaining new capabilities or services for your current customers, and expanding your staff and talent in markets where recruiting is challenging. A caution for government contractors. The combined revenue have the potential of accelerating small business graduation from the U.S. Small Business Administration set-aside programs the company benefits from. Evaluating the impact of the combined revenue on potential graduation of these programs will be critical to the decision process. Note, after an acquisition, a small business needs to recertify they remain small. In particular, the new company must show that combined revenues of the two prior companies remain below the relevant small business size standard for the prior 3 years currently and expected to be 5 years upon implementation of the Small Business Runway Act. For lifestyle businesses, remaining small is likely a better financial choice than making an acquisition that would shift the company into full and open status. Also, other than small business, buying a small must take into account the benefits of the acquisition versus the likelihood of being awarded option years or recompetes on the set-aside work. Given the majority of small businesses have set-aside contracts, this assessment is relevant in most cases. Next slide, please. Acquiring an established company with existing contracts in an agency or department in which you're trying to gain entry can be a more efficient growth strategy than bidding on new contracts. This is frequently referred to as horizontal expansion. A company gains existing contracts, past performance, and established customer relations. Acquisitions typically take 4 to 7+ months, and is generally considered a faster process than pursuing new business, which can take 12 to 18 or even longer time. Strong performance measured via CPARs and relationships or customer intimacy of the acquired company creates an opportunity for cross-selling technical offerings between the former company's customers. The result in market entry by each legacy company into the other's customer base and the opportunity to sell new solutions to existing customers. Comparing the cost of acquisition to the cost of business development, given the expense of account management, the capture process, the proposal response time, and the potential for a protest, gives an understanding of the relative return on investment between the two options. If the cost of entry is high, both financially and time-wise, then an acquisition could provide a better ROI than standing up a team to pursue business with a new customer. Next slide, please. Companies are also acquired to expand the technical offering, referred to as vertical expansion. Understanding the complete technical solution your customers are looking for provides insights into where a company should look for an acquisition. A company should consider the gaps in its offering and look for a company that can fill them. A frequent teaming partner can be a valuable acquisition. In addition, the prior experience of working together as teammates provides a good understanding of cultural fit and reduces the assumptions made. The financial analysis of the cost of teaming versus the cost of acquisition is one input into the level of value being created. Acquisitions should result in back office efficiencies as the two support teams are combined and redundancies are eliminated. Note, this is one of the most challenging aspects of integration, as the efficiencies ultimately come from reducing the size of the staff. Unless you're willing to remove team members or are able to rotate individuals to new value-add positions, the back office efficiencies won't be realized. Given the personal nature of small business, realizing this efficiency can be difficult to capitalize. Another way to consider the back office efficiencies is the larger infrastructure available to enable scaling to the next level of growth, resulting in back office efficiencies coming at a future date when the company has grown. Most business owners do not have M&A experience. A business owner may consider acquiring a small company as learning on the due diligence process, the mechanics of securing funding and closing the transaction, and executing on integration. In addition, the process of buying a company can provide valuable insights into value creation and understanding the process when looking to sell your company. Engaging in due diligence as an acquirer can give a company a better understanding of what will be required when it's looking to sell, and as a result, better position the company to navigate the process in the future. However, we would strongly caution against this rationale. A small acquisition can provide lessons learned, but the risks are exceedingly high. Engaging an experienced M&A advisory team, including financial, legal, and investment banking, is especially important for a team's initial acquisition. Newport frequently leads deal teams through the process to enable business owners to remain focused on operating the day-to-day business. Frequently overlooked is a critical role we refer to as the Chief Integration Officer, which is responsible for ensuring the integration of the acquired company into the buying company and achieving the results expected of the acquisition. Finally, the cost of a bad acquisition can be much higher than the purchase price. Next slide, please. In nearly all cases, an acquisition will require a business to increase debt. Unless the business is flush with cash or is able to convince a seller to self-finance the transaction, it may be necessary to obtain financing to acquire the business. With the stress many business owners face regarding working capital and making payroll, increased debt could add significant pressure to the operations of the business. Ideally, an acquisition would be part of a small business's strategic plan, and preparations for the cost of the acquisition would be made years in advance. Key steps include creating cash reserves for the acquisition and increasing free cash flow. The cash reserve reduces the amount of debt secured and demonstrates a business's ability to leverage its operations to self-fund growth. Aside from providing funds for an acquisition, increasing the free cash flow provides lenders the comfort the debt will be serviced and makes financing terms more favorable to the company. Part of the due diligence process will be assessing cash flow for the combined company to ensure debt payments can be made. Planning and executing an acquisition is a significant organization distraction. Even a small acquisition will become an all-encompassing activity for the senior leaders of the company, with the identification, due diligence, negotiation, and finalization of the transaction and integration taking a year or longer. With most small to medium-sized companies having limited depth in their financial, contracts, and legal teams, consideration needs to be given to the time and the focus key executives of the company will have to devote to acquisition activities. Ideally, an organization will have reached a maturity level that its senior leaders are already devoting a majority of their time to this type of strategic growth-related project. If the leadership is mired in the day-to-day operations and execution of existing contracts, the distraction factor associated with conducting acquisition could outweigh any benefits. Alternatively, if the acquisition fits squarely into the well-defined strategic plan, then it should not be considered a distraction. Or if the plan is to gain market entry into a specific agency and the acquisition achieves that goal, then there are also other positive benefits. However, if the plan is nebulous to grow, then the acquisition is likely a distraction as it may shift focus away from other opportunities or clients, putting the business at risk. One option for reducing the distraction is to hire an outside expert to lead the deal team through the transaction process from acquisition strategy, company identification, due diligence, and negotiations. Next slide, please. The due diligence process should provide good insights into the integration challenges. However, even with the extensive integration planning, organizations appearing well aligned on both culture and mission, unexpected challenges will arise throughout the process. Significant work is necessary to ensure the value to be gained from the acquisition is realized. The combination of two entities will impact staff, customers, processes, and teaming partners from both organizations. For example, existing employees of the buying company are often ignored as the leadership team spends time getting to know and work to retain the staff of the acquired company. Remembering the employees of both companies now belong to a newly formed organization is a good strategy for integration planning, especially with respect to internal communications. Benefit packages and culture changes are areas employees are especially concerned about. In the end, the success of the deal and strength of the resulting company will depend on the accuracy of the assumptions and projections. Taking the time during the due diligence process to understand the sensitivity of the outcome of the key assumptions and projections will ensure the risk being assumed is understood. For example, an assumption could be the seller will maintain its recompete rate. Looking at the impact of a 5 to 10% lower or higher win rate will provide an appreciation of the importance of this assumption to the value of the deal. The due diligence process should identify the 3 to 5 assumptions having the most significant impact on value creation. By assessing a range of values for these key assumptions, the executive team gains knowledge into the most critical elements to focus on during integration, understands the level of risk being assumed. For small businesses, projecting the importance of the owner and their involvement after the deal is critical, as some small businesses rely upon owners for everything from operations to relationships. As mentioned earlier, bringing a chief integration officer into the team reduces the risk of organizational distractions, and achieving a strongly integrated company where both sides feel they belong to a vibrant new organization is a good option for reducing risk. Next slide, please. Growth through acquisition is an option that should be constantly considered. As a business owner engages with the market, learning about companies that could be target acquisitions is good preparation for the future. However, the decision to move from consideration to execution of an acquisition has significant impacts on the future of the business. The benefits need to be meaningfully greater than the risk. A poorly executed acquisition can jeopardize both the business's existence and the owner's financial future, as most owners will sign personal guarantees on any bank debt. The initial assessment can be conducted internally with consideration given to new business opportunities and increased profitability. Validating internal calculations with an independent third party should be completed prior to engaging a full M&A team, which would include M&A experts in legal and accounting and an investment banking organization. In particular, a valuation company can provide an estimation of the price of the company pre and post merger to understand the value being created and bound the purchase price. Even if the finances of the deal are strongly favorable, the organization's capacity to successfully navigate the distraction to a fully integrated new entity needs to be realistically evaluated. The Business Owners Advisory Board or a CEO advisor can provide a diverse set of perspectives and help inform a decision. In addition to the qualitative analysis discussed above, the human reaction also needs to be taken into account. Taking a poll of the leadership team's gut reaction to the prospective acquisition will uncover the level of support for proceeding, as long as you built an organization trust for each team member to speak freely and openly. Thinking about your motivations and the comfort with the deal will be the final decision element. Next slide, please. If you're planning graduating from small business status, the Small to Large Transition Challenge program Newport is conducting could be a good opportunity for you to create your company's tailored graduation strategy with me as the lead facilitator. Over the course of 6 months, 12 CEO guest speakers who have successfully navigated graduation share their lessons learned around specific topics for their graduation plan, including value proposition, growth via acquisition, if and when to establish a board, and maturing operations. CEO guest speakers include George Wilson from ECS Federal, Karen Trowbridge from Trowbridge & Trowbridge, Julian Setien from Soci, and 9 other GovCon giants. The program divides its time equally between the CEO guest speakers and workshops facilitated by Newport partners. By the end of the program, each company will have created their tailored graduation strategy, incorporating the lessons learned from 12 outstanding companies. We are taking inquiries into the next cohort now. Go to newportprograms.com to learn more about the program. Next slide, please. Thank you for joining me. Please reach out with any further questions. This webinar is based upon an article posted in LinkedIn in May 2018. If you're interested in receiving a PDF version, please send me an email. You can also check out the weekly videos I post on LinkedIn, which address different aspects of GovCon growth and navigating the small to large transition. I look forward to speaking with you and hopefully seeing you in the next cohort of our program. Back to you, Mallory.
Thank you, Heather, for sharing your knowledge and insight today. Today's presentation has been recorded and can be found on our website or YouTube channel within about 48 hours. If you have questions about today's topic, please contact Heather at the phone number or email shown on your screen. And thank you, everybody. This concludes the webinar.